Good morning, good afternoon, good evening, wherever you're watching me today. My name is Peter. Welcome back to another episode of Invest with Peter. So today I'm going to be talking about 5 mistakes, investors made that to ruin their portfolio. We all started somewhere and, in the journey of investing, we all think, oh, I know it, or somebody's giving me a clue. I've been watching these people. I've been watching this guy. I've been reading this book. But it comes to how you actually want to put your money in, when you want to put that money in, and what your projection for your portfolio is. These are the things that you need to understand before, thinking of like even putting your real money into investing. You need to understand, okay, why do I want to invest? How much do I need to invest? What's my projection? What's my strategy? And what do I want to buy? Do I believe in this project? Do I believe in this company? And what's my investing strategy? Because if you don't have those strategies in place, you just come into the market as if you go into a casino, and guess what? You will lose your money in due time. It's happened to me. I've learned from these mistakes that I'm going to be sharing today, right? So if you want to learn, you can take a pen and write, or probably get a cup of coffee, sit down, and enjoy this episode. So the first one, okay, I wrote them down because I don't want to mix any points together. So I'm going to be going in them in details and explain them one by one. So the first one is DCA wrongly. We all know the word DCA is dollar cost average. So it's called dollar cost average. We all know, like, okay, people, you listen to YouTubers to tell you, oh, dollar cost average into this, dollar cost average into that. But how do you dollar cost average? You need to understand how to dollar cost average. Some people tend to dollar cost average up, or tends to dollar cost average down. For me, I prefer to dollar cost average down. Some people will say, oh, just dollar cost average every week, put 100 quid in that company, or every week, every Monday, put 100 quid. I don't do my dollar cost averaging like that. But if you want to do it that way, that's your choice. But if you dollar cost average wrongly, you will ruin your portfolio. For example, let's say a price of Pepsi stock is $159, right? And somebody's told you, don't worry, just dollar cost average for the next 10 years, okay? And this company, you probably, see that company at 159 and you buy like, 100 quid worth today. So next week, the company is 162, you buy, another 100 quid. The other week, another 100 quid. You do that for yourself if that's what you want, if that's what you understand. But for me, I'll tell you my strategy. I prefer to wait until I go through their earnings. I check the calendar every year for each company I hold in my portfolio. And I understand, like, okay, when this company is, trying to, give their earnings, sometimes they have a mixed bag. Sometimes they have a good earnings. Sometimes they have bad earnings. So I always wait for the report, like, okay, this report is quite bad. And that's when I start dollar cost average down. For example, Pepsi dropped their earnings a couple of days ago, and the earnings was really bad. So not really bad, but it was not really what market was expecting from them. So it went from 162 to 157, and I said, yeah, I bought one at 158. It went to 157. I bought one as well. And all because I know these are the solid companies that you want to hold for a long time. Some of them are dividend kings as well, dividend paying companies. So for those companies that you want to hold for a long time, it's better to get it at a cheaper price than buying it at the price goes on. So I prefer to dollar cost average down. As for me, that's what I've been doing, and it works for me, right? Because I know once it turns around, all my positions are going to go green straight away. All right. So sometimes I get it right, sometimes I get it wrong. Nobody understands the market in full. Nobody can say, I know where the market direction is going to go in the next 3 months, in the next 2 weeks, not even tomorrow. You don't know what market is going to do tomorrow. So nobody knows all. So don't dollar cost average wrongly. Choose your style. I've told you my style, and you can choose your style. Dollar cost average up or dollar cost average down. Monthly, weekly, yearly, your choice, right? Second one is losing focus on your winning stocks. We all have a winning stock. My winning stock is Nvidia, Microsoft, and also Apple. Those are my 3 winning stocks. Those positions in my portfolio, they are pure green. So They are my winning stocks. I understand what this company does. I understand the limitation of this company. I understand the advantage these companies are holding against their competitors and all that. So I know, yeah, I know that, okay, this company is my favorite, put it that way. It's my golden egg. So I know how to trade them, and I know how to say, anyway, I don't trade them. I just buy them and keep for a long time. So you need to understand them properly, and that's where you know you want to keep the big money in. You don't want to be, jumping in and out, in and out, in and out. Focus on the winning stocks, and it's going to help your portfolio. So your choice. Another one is being distracted by the media. So we all wake up every morning. Oh, Bloomberg says these, Yahoo Finance says these, CNBC is talking about this company. It's going to go down the drain. It's going to do that. Be very careful. Those people actually doing their 9 to 5 job. I know some of them, they hold some companies, they want to hype. We are all human, but be very careful the information you take from what these people are talking about. They are paid to come every morning to tell you what they feel, what somebody feels about it, what their favorite investor or chairman says about this company. They are there to project what they want to say, not what you might want to know. So be very careful. All this news, financial news media that you listen to, or they say tomorrow Chipotle is gonna be losing the CEO, and that's gonna drive the company price down by -5%. Or you may not, if they don't get a good CEO, they keep every day they get a new random news to move the market. But if you get swayed by all this information, you're gonna ruin your portfolio, and you're gonna be there to hold the bag. You're using that as your market strategy for your portfolio. It's not really healthy for your portfolio. So be very careful what you take from what they're talking about, right? So next one is not having a strategy. I've mentioned strategy in my video over 1,000 times, right? You must have a strategy, whether your exit strategy, right? Your buying strategy, your selling strategy, or your positioning strategy. If you don't understand all these principles, all this strategy, you're just wasting your time. You're just putting money as if you're just gambling. You don't have a clue what's going to happen, and it's going to destroy you. I have a strategy. Like me, I know when the company I buy is giving like 2 bad earnings consecutively, I know I'm not buying into that company anymore. But I'm not going to sell out of that company because I don't want to lose money. Right? The Oracle of Omaha says the first rule in investing, don't lose money. The second one is, don't forget rule number 1, never lose money. So even if my portfolio goes to -90%, I'm not going to sell it. The only thing I'm not going to do is to buy into that company again. It's going to be there 5 years, 10 years. I don't care. That money has to come back to me. So I'd rather use a new money to invest and all that stuff. So that's what I do. My strategy is, if a company releases 2 bad earnings consecutively, I stop buying into that company and I move on to the ones I've done my due diligence to get my gains back from it. So we all win some and lose some. Another one is making a penny stock the largest part of your portfolio. Goodness me, these always affect new investors, because somebody say, oh, this company has gone up 70% in just 2 or 3 weeks. Let me just put £1,000, £15,000, $1,000 in there. By the time you wake up the following morning, that company that went 70% the other day is gone down -80% today. The whole investment you put in there yesterday is all wiped out. Be very careful. Understand the company you're buying. Don't make penny stock company the largest part of your portfolio. Is going to ruin your portfolio. Get the bigger ones that like Coca-Cola, PepsiCo, Apple, the likes of Tesla. You may have your, arguably you may put Tesla there. So, and these are Nvidia, and maybe you are tech, you are into tech and your portfolio is full of tech. That's you. If you're with consumer staples, dividend companies, Chevron, and all those ones that pay good dividends, stick with them. Company that are in 3-digit billions of dollar worth. Stay with them, and even if they go down 3-4%, they're still gonna come back up and all that stuff. Do not invest your totality into penny stocks. It's gonna ruin your portfolio. So I've done that before. I've learned my lesson, and that's why I'm telling you now that it's not gonna help you and it's not gonna take your portfolio anywhere. These are the 5 major problems that you need to deal with if you want your portfolio to go up in, numbers and, to make you money. So that's it from me, guys. Thank you very much for your support, and I'll see you some other time. My name is Peter Hart. Please subscribe, share this video with your friend that you know are just coming to investing. Thank you. I'll see you some other time, and bye.